The Commonwealth Bank and the ANZ have both passed on the RBA's latest interest rate rise to mortgage borrowers in full. Mortgage holders are bracing for even higher repayments as the Reserve Bank flags further rate hikes are on the way. Joining us live with analysis is PropTrack senior economist Eleanor Creagh. Eleanor, really appreciate your time. Thank you. What is the outlook now for the property market after that latest rate hike?
Certainly, we are expecting housing prices to continue to fall and those price falls are likely to become more widespread. We have already seen as interest rates have risen, as housing affordability is constrained, borrowing capacity has been reduced and mortgage rates have risen, that the housing market has slowed and it has slowed quite quickly. Now that's been reflected in moderating buyer demand. So prospective buyers at the moment have a lot more uncertainty around future borrowing costs than they have done over the past couple of years. And that's certainly denting confidence a little bit for prospective buyers. We're also seeing auction volumes reducing and auction clearance rates reducing as well, and sales volumes coming off alongside house prices already falling.
So when we look at those house prices falling, particularly in Sydney and Melbourne, how big is the drop so far, and why aren't we seeing similar falls in the other capital cities?
Certainly. So when we look at Sydney and Melbourne, so from the peak of Sydney home prices, we're off around 1.5%. In Melbourne, that's a little bit more. Home prices peaked in Melbourne in February this year and since have fallen around 1.8%. But it's a different story in the smaller capitals. You're quite right to point that out. And what we've seen really is that population gains, relative affordability. Those smaller capitals have also benefited from preference shifts towards larger homes that we've seen throughout the last 2 years since the onset of COVID. And of course, people kind of travelling north towards Queensland to avoid harsh lockdown restrictions for much of last year in Sydney and Melbourne. And those factors have really seen momentum remaining a lot stronger in the Brisbane and regional Queensland market, but also in Adelaide as well. We've seen that momentum in the Adelaide housing market has also remained pretty strong.
Are we getting into the territory where we'll see a lot of people having to default on their loans, or are most borrowers actually well placed, do you think, to handle the rate rises thus far?
Yeah, look, it's a really interesting question, and there is a lot of nuance here. So when we look at RBA estimates, actually around 40% of variable rate borrowers won't actually have to see their repayments increase until the cash rate hits above 2.1%. And then if we look at those borrowers on fixed rates, a significant proportion of those borrowers who have taken out fixed rates, those fixed terms don't roll until next year. So actually, if you do the math on that, it means that more than half of borrowers actually haven't seen an increase in their repayments yet. So households have used this period of record low interest rates to pay down debt faster. Many people actually didn't reduce their payments when interest rates fell to record lows over the last couple of years. In addition, households are sitting on huge savings buffers, so some 240 billion in excess savings. And also, I think another factor there is the significant home equity that a lot of households are sitting on. So we've seen extraordinary price rises over the last 2 years. Nationally, home prices are up 34% on pre-pandemic levels, and that does mean that a lot of people are sitting on quite substantial buffers, and they should be able to avoid financial stress.
So, Eleanor, what is your expectation as to how long it will take for the RBA to get inflation to its target range? When will these interest rate rises actually really be noticeable in terms of the overall inflationary impact?
Yeah, look, it's a really great question. And there's certainly a lot of uncertainty out there still with respect to the inflationary outlook and inflationary pressures. So we know that a proportion of those inflationary pressures have been driven by supply side constraints. We've still got ongoing issues in China that are filtering into that. We've also had geopolitical tensions as well that have fed into those inflationary pressures and supply side inflationary pressures. But we have started to see those inflationary pressures pressures broaden out and also hit services sector. And we've also seen inflation in food, gas, electricity, and the like. So households certainly are feeling the pinch, especially given that we haven't actually seen that material increase in wages growth or stronger wages growth coming through to offset those cost of living pressures that the RBA are looking for. But I think that as we head into probably the end of this year and the beginning of next year, we are going to see that a lot of those supply side inflationary pressures do start to come off the boil a little bit, and we should be sitting on a more even keel with respect to inflation.
Eleanor, Creagh, really appreciate your analysis and insights. Thanks so much for joining us.
Thanks for having me.